what exactly have bull markets looked like in the past, and what exactly have bear markets looked like in the past? I think that's a very important question to answer, because if we don't know what they look like and we don't know how to spot them, then it's going to be difficult for us to know how to win or profit based on what exactly these different types of markets look like, okay? So if you look at the statistics, okay, since 1942, so we are looking at this point, nearly 80 years of data. Okay, but if you look since 1942, daily stock returns of the S&P 500 index, okay, and you look at bear market periods, okay, so let's start with the bad and then follow it up with the good. Bear markets have lasted on average 11.3 months with an average cumulative loss of 32.1%, okay? So the average cumulative loss, meaning the total loss, really, I don't want to call it a loss because we're not necessarily cashing in on the loss, right? You only lose money if you sell, okay? But if you look at the average drawdown, the average cumulative drawdown of the stock market, it was 32.1% and lasted only 11.3 months. So bear markets last less than a year on average. So that means to go down over 20% and then make it back to the point at which the stocks were at their high, they last on average 11.3 months. Now, how does that compare with bull markets? Well, bull market periods on average last 4.4 years. Okay, so 11.3 months for bear markets, but 4.4 years for bull markets. Okay, with an average cumulative total return of 152.6%, compared with the negative 32.1% cumulative loss of a bear market. Okay, so you tell me, why would you not want to be invested in the stock market? Okay, if the positive times are going to be over 4 times as long as the negative times, and the gains of the positive times are going to be over 5 times as large as the losses of the negative times. Okay, this is one of the biggest arguments for being invested in the stock market over the long term, because people are so scared of the bear markets, and the bear markets get so much in the way of attention from the market. They get so much attention because people are like, oh, it's so bad. Things are horrible. We've lost 30-something%. The economy stinks. Unemployment's high. All these different types of things, which can be true, right? I'm not saying these things are not true. I'm just saying that it is irrational that we look at these things with so much negativity and not look at the upside. We're pessimistic people as a country. We're pessimistic people. Typically as investors, we are quite pessimistic. But to take an optimistic view, just look at bull markets. You don't hear every day on the news that, oh, the stock market has gone up 2% today, or it's up 70% since the bottom of the coronavirus pandemic. You don't hear that, right? But during the coronavirus pandemic, when it first began, during that crash, right, all you were hearing every day was, oh, stocks are down 5%, stocks are down 4%, stocks are down, everything's horrible. There was red on every screen. It was on 24/7. It was on at night when it's not typically on CNBC, right? All the investing shows, because everybody was just so darn stressed out about what was going on with their money. But why aren't these things occurring when things are good? Because things being good last so much longer, and it's so much more pronounced than the bad. Now, the longest bull market that we have had has been 12.3 years, and that's based on the definition that I've given to you previously. But that bull market was from the late 80s into the 90s, before the dot-com crash at the end of the 90s, right? But many will say, they will argue that the bull market of the 2010s, from the Great recession all the way up until the coronavirus crash, was the longest actual bull market that we've had as an economy, because a part of that one bull market during the 90s was a recession, right? And so people say that even though there was a bull market as far as the definition that I gave, that doesn't necessarily mean that everything was going well. And so they kind of discount that back to the recession, which makes the most recent bull market the longest. Now, from that bear market in the late 80s all the way to the late 90s, that bull market that they identify there is 582.1% cumulative gain. Could you imagine if you would have sold out in the late 80s, right? During Black Monday in 1987 and all those different types of things where things were just, oh, so horrible, the worst one day in stock market history. If you would have just sold out and stayed out for the next 10 years, you would have lost some of the best gains that there have ever been in the stock market. Okay. And the average annual return then was 16.9% annually, which is just a fantastic average annual return. Then the most recent bull market lasted about 11 years and had a 400.5% cumulative gain. And the average annual return was 15.8%, which is, again, absolutely awesome. That's an awesome average annual return. But if you really want to know how crazy it is to think that bear markets are so horrible relative to bull markets, you can look at the most recent bear market. The most recent bear market lasted 1.1 months. Okay, by the definition that I've given here. And the depth of it, the loss of that bear market was 33.9%. Okay, you would just come off a period where you could have made 400.5% and you just lose 33.9% of that. Well, guess what? Since then, the 9 or so months since that drawdown, or 10 months since that drawdown that is given here, we're missing just a couple months of current data. And what I'm using is statistics from First Trust, really good things. You can look up First Trust, bulls and bears, and get this same printout that I'm looking at here. The upside since that bear market, right, in that 9.3 months following that bear market was 67.9%. So who cares if you lost 33% in your investment value? You've made over 60% since then, right? You've made nearly 70% since then, okay? So it is irrational to think that bear markets are so horrible and bull markets are just all right. No, bull markets are amazing relative to bear markets, okay? Bear markets hurt for a short period of time, but bull markets are sustained upside, and they are the reason that we invest, right? If you are not overall bullish about stocks over the long term, then you haven't done enough research. You haven't looked into your history books enough. One book that I would recommend that talks about this, and I've talked about it before here on this show, is Stocks for the Long Run by Jeremy Siegel, right? That book is fantastic and tells you everything you want to know about long run stock returns and tells you why you should be invested in stocks over the long run. But this is a great example, right? These bull markets relative to the bear markets. If you looked at this sheet that I'm looking at here, the bull markets are these long, huge, expansive graphs that look really big and powerful. And then the bear markets are just blips, right? They are blips on the radar. And when it all comes down to it, they are blips on the radar. Look at the S&P 500 chart. Go to Google and just type in S&P 500 and go to the max, right? The maximum amount of time you can look at the S&P 500. And just look at that chart. You will barely be able to recognize the bear markets that we've had. Yes, the most recent one you will be able to see, and you'll probably be able to see a little bit from the Great Recession and the dot-com bubble, but they won't be the gouges that you think they are, right? For the most part, that graph moves up and to the right, which means that stocks are going up in value over the long term.